The big event to hit financial nerve centers in Washington this week was China's decision to allow its currency, the yuan, to depreciate in value. This affects the Federal Reserve, perhaps none more than any other institution here in Washington. The Fed is thinking about raising short-term interest rates, possibly as early as September. But if the yuan is depreciating in value against the dollar, and other currencies start depreciating against the dollar, that puts downward pressure on U.S. inflation at a time when the Fed wants inflation to rise. It makes it harder for the Fed to raise interest rates. The IMF and the U.S. Treasury are also watching very carefully China's moves. They've been putting pressure on the Chinese government to allow market forces to determine where the yuan goes. And that's exactly what the Chinese government said it was doing with this decision. The worry, however, is that the depreciation of the yuan goes even farther. What started out as being market forces becomes actually an effort by the Chinese government to depreciate their currency to gain trade advantage, to pick up exports at a time when their own growth is slowing. That's exactly what Republicans and Democrats on Capitol Hill are worried about, and they're more vocal than anyone else right now in keeping an eye out for the Chinese. We don't know how far this is going to go at this point, but it's something you need to watch.